Hello and welcome to Switzer TV. I'm Paul Ricard, filling in for Peter Switzer. A lot of commentary in the media, amongst the analyst community, and certainly the things that I've been writing in the Switzer report about the banks looking super expensive, but they haven't been going down in price. And I wonder why that's the case, and also whether the expensive theme really stacks out. I want to explore that, and joining me to discuss that this week is Adam Dawes from Shaw & Partners. He also throws some light on an interesting switch amongst a couple of our big major retailers. And later in the program, we've got SD Wong from Prime Value. I want to look at some of the key investment themes that he's been looking at and what he makes of those themes post-reporting season and what he's investing in. First up, Adam Dawes from Shaw & Partners. Last week, Macquarie issued a research report basically downgrading all of the major banks and basically echoing what many of us have been saying for some time, that they're pretty expensive. I want to get a bit of a check on that and also look at what other stocks possibly could be considered for profit taking at the moment. Joining me now is Adam Dawes. He's the Senior Portfolio Manager at Shaw & Partners. Adam, welcome to the program.
It's great to be here, Paul. Thanks so much.
Well, I'm sure Shaw's got its own views, but Macquarie got some publicity last week, came out and said the banks were very expensive. A lot of people have been saying that now, me included, in my case, probably now for over a month.
Yeah.
But they don't seem to be going down. So first of all, what's your rationale behind that? And secondly, do you agree they're expensive?
Oh, look, the rationale behind the banks is that, everyone potentially is chasing yield. And that yield, I don't think you're going to find too many other places that you could, get. So I think, the banks certainly look okay from a dividend yield perspective. And then you overlay interest rates and potentially interest rates falling. It definitely means that the banks are looking a little bit more appealing, going forward. But I'm with you, Paul. The banks have had a stellar run, absolutely stellar run. And I don't think I've ever seen, and I've been in markets sort of 20 years, I don't think I've actually seen the markets and the banks run this hard, just continue to move higher over time. And so, yeah, it does say naturally there will be some kind of pullback or at least some kind of rationalization inside of the industry or inside the sector. But yeah, Macquarie definitely came out and they also came out with a big commodities piece a couple of days after that, saying that they think a lot of the commodities are undervalued. And so, you potentially might see a bit of a rotation out of the financials into the commodities side of things, going forward.
Well, but obviously following me in that, I've been saying that now for a couple of weeks, but have been out of sync with the market. But I put it down to coming to the banks a little bit that the institutions are afraid to sell them. And it's, I guess, when you're getting such positive stimulus in terms of global equity markets are hitting a high, we all know our market is so dominated by the banks and resources. And when one of the sectors, resources, have been coming off the boil, it's probably very hard for an institution to sell banks at the same time. Where else do they invest? So I think that's sort of almost like looks like they've been scared to sell them.
Well, and I'd agree with that, but then I'd also take it another step that it's really hard to get retail clients to sell their banks also. So, even though you might not think that retail, doesn't, take a big sway inside the banks, they're holding on to a lot of their banks and they're very, very happy at the moment. So they're the sort of the Cheshire cat there, sitting there licking their lips and sort of enjoying their time in the sun. So it does make it a little bit difficult to sort of play those banks. But, we're starting to see some cracks starting to come out with the banks. All of the banks have now started just to, instead of that, continued rise, they're just plateauing out a little bit. And that potentially might see a little bit of a downturn in the next coming couple of weeks.
Okay, so if you've got a portfolio where you've got each of the major banks, let me put you and Shaw & Partners on the spot. What's your most preferred of the major banks and what's your least preferred?
Well, it has to be Macquarie, doesn't it, really? I mean, these guys, they do very well. Rain, hail or shine, these guys will do very, very well. And I think, even at that sort of $200 mark where Macquarie hit and now sort of pulled back a little bit, I still think there's a lot in the tank to go with Macquarie. So that's definitely my favourite of the banks. And looking to the most or the not so favourite, it's always been the regionals. Bendigo, if you overlay a chart of Westpac, ANZ, and Bendigo, Westpac and ANZ have just left them behind. And the Bendigos or the regional banks, again, is something that I potentially would be selling. If you ask me about the big four, you would look at ANZ and Westpac to take some profits. I think NAB's still probably got a little bit more room to move with that business side of things. But, that mortgage market is definitely heating up. And I think, you'd probably take some profits in ANZ or Westpac, and I'd definitely be selling any of the regionals at the moment.
Okay. Let me move on to the IT sector, because another sector that we've done okay at, or we've done quite well, but not as good as the States. And of course, it's very now dominated by 2 or 3 companies with the WiseTech and also NextDC, and there's a couple others not in the sector, but very close, like the car group. WiseTech, I think, is trading on a forward P of almost 80 times or something. Looks super expensive, but it keeps on hitting new highs. Now, what's your take on that stock?
Look, it's a one in a million stock as far as WiseTech. They've got this amazing technology. It's global, that technology. It's not just here in Australia. It is global, and they're continuing to winning contracts overall. They had a bit of a slip up last year, sort of end of last year, and that was probably your time to get in. I think it got down to sort of $60, $65, and now approaching closer to 100. I think it looks a little bit stretched up here. But WiseTech is certainly one of those businesses that can continue to deliver, but it has to deliver because it is at that growth side of the market. And so I'd be a little bit cautious up here. If we did see a little bit more of a sell-off or some kind of pullback again on WiseTech, I think this is a fantastic business, and you would definitely back up the truck on WiseTech going forward. But overall, I think our technology space has done very, very well. The likes of Xero, NextDC, as you spoke about, they have done very, very well. And so it's a little bit of a hard one to sort of take some profits where we are at the moment, because if NVIDIA, all of these big businesses in the US, if they can continue to keep running, that will continue to push our tech sector higher. The other side of it is, Paul, that our Australian market doesn't really know how to rate or price technology businesses. And you saw that with Altium. The Japanese have come in, they've said it's far too cheap, we like this business, and that will pretty much go to a foreign hand. So I think Australia needs to wake up a little bit for our tech sector and price them accordingly to a global standard, which should see all boats rise as the tide rises also.
So that's a bit of a caution from you, I think, on taking profits in that sector. Is that right?
Yeah, I think so. I mean, I sort of feel like that back in 2000, the technology story was great, but there was no revenue. Now, that was a tech boom. Now we've got revenue, and it's a great story, and we've got revenue, and they are profitable. So I'd be cautious about taking too much money out, especially because there's so many international buyers out there that price our technology price their technology businesses higher, and whereas we just struggle to rate them on a global scale. So yeah, we're very, very bullish on the technology sector at the moment.
So Adam, if you are looking to take profits, we've sort of ruled out technology. Do you have any stocks or sectors you're more inclined to be looking at?
Well, look, the first one is something like a Goodman Group. Again, off a little bit today. It's pseudo technology, but it's really started to talk about the data centers that they've had, or the data centers that are operating there. Those guys have had a stellar run, and it's a fantastic business. And I remember talking to you 6 months or even longer ago saying, look, Goodman Group is a fantastic buy. It's a great business. Potentially at the sort of $30 mark, $29.60 where it is today, there's a little bit of heat coming out of that one. So yeah, you could definitely take some profits there.
I think when we were talking, Adam, it was around about $20 or even less. So it's had a huge run, hasn't it?
Yeah, it's been really, really good. And I think, overall, it's one of those businesses that will continue to do well. Most brokers are upgrading price targets now to sort of 35, plus dollars. So a little bit of, sort of take off the table there. is probably not a bad idea, but it's still trading on this, data center business, as well as NextDC has done very, very well on the back of that as well. So, there's a little bit of profit taking could be done in that space.
Any others apart from Goodman Group?
Well, I mean, yeah, I like NextDC. I mean, I know we just said don't take profits in the tech space, but NextDC obviously is rallying really, really well. Also, you could probably do a little bit there. Well, again, WiseTech, it's a tough space, but encroaching into that $100 mark, I think you could take a little bit there as well. Look, certainly the resources space has been, it's a cyclical side of things, and the cycle's not in the right space for that that one at the moment. Though the other one that I've been taking a little bit of profit on is Wesfarmers, and I've been doing a switch from Wesfarmers to Woolies. It might be a little bit tough for some people to sort of stomach, but Wesfarmers has had a great run. Woolies is certainly in the doldrums at the moment, and that's not a bad trade at the moment.
That looks interesting because Wesfarmers, you say, has had a great run. If you're not familiar with Wesfarmers, that's the Bunnings business plus Kmart. Market got really excited in reporting season because Kmart did better. Throwing a bit of lithium there also through Kidman Resources, and there's also a mining division. But Woolworths is out of favour because of everything that's happening with, the government pressure and others on the big retailers. The question is that pressure could continue though for some time. It's a question of, I guess, do you think we've seen the price come off? Do you think that's enough price action on Woolworths, or just play it out for the long game?
Yeah, so it's definitely a long game. I think, certainly you look at what we call the jaws, that Wesfarmers going higher and then Woolies going lower. There has to be some kind of normalization to that. I think Woolies is in a tough space at the moment as far as that it's the Qantas effect. It's about the reputation. It's not about the price or the earnings or anything like that. It's just a reputation damage that they're going through at the moment. But as we know, businesses do go through these tough times, and Woolies is a very, very good business that knows exactly what they're doing. So I just think that, yeah, there is a possibility that you could switch out a little bit of Wesies, buying into some Woolies. I think is a really nice switch. It does show you that they're both good quality blue chip stocks. Woolies is a little bit out of favour, and geez, Wesfarmers has had a great run. So yeah, I've been doing a bit of switching for clients in both of those over the last couple of weeks.
And finally, just to round it out, Adam, a stock that you like at the moment?
Yeah, so there's a couple there. I know I'm going to go on to some of the boring stocks because the market's all about growth.
We like boring, right?
Yeah, well, I do as well. It helps me sleep at night. So some of the boring stocks and the market is in that growth phase. So it is a little bit sort of counter-cyclical to what's going on. But Transurban certainly does look pretty well. We've seen a lot of congestion data, which is suggesting that there's going to be a step up in traffic in the March quarter. Sydney's traffic data's up by about 9%, Melbourne's up by about 7%, and Brisbane's up by about 10%. Now, while congestion doesn't equal traffic or Transurban traffic, the historical correlation is quite compelling. And basically, by the second half of 2024, we should see some upside to some of those traffic numbers, which should flow through to Transurban going forward. So that's one. Look, I think that it looks interesting. It's a little bit boring, out of cycle. I think that one is a good stalwart for the portfolio. And the other one that I've been looking at is Qantas. I've been a naysayer on Qantas as far as it's too big of an asset. It's tough. There's lots of capex going. But we have seen Australian domestic fares down around about by 2%, and capacity is definitely up around about sort of 95 to 100%. So albeit while fares are down, the overall market, I think, is definitely stabilising, and it could be one to put in the bottom drawer, Qantas, going forward.
Okay, we're going to note the Qantas and Transurban. I agree with you about Transurban. And also I do like the Wesfarmers Woolies switch. Looks interesting. Yeah. And also your thoughts about the banks. As ever, some really great insights. That's Adam Dawes from Shaw & Partners. Thanks for joining us on Switzer.
Thanks so much. Great to be here.
That's all for this week. A really interesting idea there, I think, from Adam Dawes about the switch out of Wesfarmers back into Woolworths, but you will need to be patient. But what you didn't see this week was ST Wong from Prime Value. You will need to be a subscriber to see that and sign up. We'd love to have you on board with the Switzer team. We'll see you again next week.